to do problem 10.6. So hopefully it will make sense as we go along, not just email me with questions. So on October 1st, year 6, Versatile Company contracted to sell merchandise to a company in Switzerland. So they contracted to sell. Now, notice it didn't say they sold. They contracted, which means they signed a contract. Means it's an unrecognized firm commitment. They're going to sell merchandise to a customer in Switzerland. Selling price of CHF, so Swiss francs, for 400,000. So I like to draw a little diagram for myself so I know if we're getting or giving the foreign currency. So here's Versatile. And here's the Swiss Co. So we are going to sell merchandise. So our inventory is going that way. And we are getting CHF 400,000. So now, a little bit. Trying my new camera. Hopefully it's clear enough because the sound on this one should work. Okay. So in this case, we are getting a foreign currency. So and the payments due on delivery. October 1st, they arranged a forward contract to deliver CHF. So that's where I'm going to put Versatile. Doesn't say who it's with, but that's okay. Be a foreign exchange of some kind. So Forex. And we are giving CHF 400,000. And we are getting Canadian dollars. And that's equal to 400,000 times the forward contract rate on the date of the contract. So 1.2 equals 480. Okay, so that kind of sets out what's happening. Now, merchandise was delivered January 31st, and it was received and delivered to the bank. Here's the exchange rates. Remember, the spot rate goes for the transaction. And the forward rate is for the forward contract. So don't get that mixed up. Remember, at the end, they're equal. So if you're only given one, you can use it for either one. What? So prepare the journal entries Versatile should make to record the events described, assuming it's a cash flow hedge. So we're going to do that one. The partial trial balance of the accounts. You can look at that in the solution. And the journal entries for the fair value hedge, we're going to do that. And then both of these, you can look at the solution online to figure it out. The cash flow hedge. So part A is going to be the cash flow hedge. Hedge means gains and losses in OCI on the hedging instrument. Then reclassify. Okay, so let's start. Year 6. That's the date of the contract. So, first thing, hedged item, entry, just a contract. So, if this would have been introductory accounting, it would say signed a contract for X. We wouldn't record revenue or cost of goods sold or anything like that because it hasn't occurred yet. Second thing, ELF, which is the forward contract. Remember, using the net method, because that's what we're always going to use. No entry, instead a memo, and you just describe it. To deliver 400,000 CHF, etc. So now we're going to go to the year end. Almost always there's going to be the transaction, then the year end, then the settlement. So we are at December 31st, year 6, and it's year end. So you do these in 2 colors. We'll use so hard with these colors. We'll use blue, light blue for the hedged item. Hedge item, no entry, no transactions. We'll use for the hedge. So for the hedge, something has occurred. Now we need to see what's happened. Because we're using the hedge, we have to go up here and look at the forward contract rates. So from here to here, what happened to the Swiss francs? They went up. So CHF went up. That's great. Everybody can identify that, right? Now tell me, is that good or bad for us? Because on the hedge, we are giving away the foreign currency, the francs or the CHF. We're giving away CHF. So in order to give it away, you've got to get a big wheelbarrow full of it. We've got to fill it. And to do that, we have to buy it. To buy it, if the price has gone up, is that good or bad for us? That's not good. Because we are giving it. So it's going to be a loss. Now, you guys, this question, it's not so much memorizing the transactions. Yeah, you have to do that. But the whole understanding and what they're going to look for in the CPA when you get there isn't so much that you memorized all the transactions. It's did you get this right? That we're giving, so it's going to be a loss. That shows you have an understanding of what's happening in the transaction. So not getting that, even if you had the transactions right, just all backwards, they're going to go, well, you didn't understand the main underlying point. So be careful with this. This is the critical point because it leads to this. Okay? So let's go do the entry. So we know it's a loss, and we use the forward rates. So we're going to debit loss on exchange or some kind of loss, OCI, make sure you put in OCI, and credit the forward contract, and it's going to be 400,000 times the difference in the exchange rates. So 1.22 minus 1.2. That is going to equal 8,000. Notice this starts as a liability because it's got a credit balance. Let's then go to another page. I'm just going to grab some paper. Okay, so that takes care of December 31st. Now it's settlement date. So settlement is January 31st, year 7. So there's a lot of steps. So basically we are doing delivery of merchandise and record sale first for the hedged item. Then we're going to settle the forward contract. Let's do the sale. So first we're going to do the hedged item. And the order doesn't matter on these, you guys. So record the sale. So we debit cash and credit sales. Now we use the spot rate on the date of the sale. So we go back, take a look at our question. We're dealing with January 31st. The spot rate is 119. Remember, they're equal, so as long as you're given one of them, you can use it. So that's 1.19. Thousand is 476. Okay, and that's it for the hedged item. Now the forward contract trying to keep this focused, you guys, but I don't know if this camera is a good enough camera. The forward contract to fair value, and remember we do an OCI first, then reclassify. So are we giving or getting? We're giving. Back here. I want to see what happened here. CHF went down. We are giving away foreign currency. So is this good or bad for us? It's good. So it's going to be a gain. Again, you guys, if you're having any problems with this, that's what you need to ask me about. The entries are just memory work. That's the understanding part. Okay. So we know we have a gain. And debit the forward contract and credit the gain on exchange. Don't forget to put it in OCI. Times 1.22 minus 1.19. And that works out to 12,000. T account of our forward contract, which we are. And you don't have to, you guys. This is just something that I like to keep track of. We originally had a loss of 8,000 way back on the other page. Then we had a gain, so notice this is an asset side, of 12,000. So our balance is 4,000. Okay? So that's done. Now the third step we have to do is settle with the bank and close the forward contract. So you can do this with one entry to cash. I like to do it with two, but you can net them out. So I'm going to get, again, looking at our little forward contract, we're going to get Canadian dollars, give the Swiss currency. So we're going to get cash in Canadian dollars and give away, oh, I meant to write cash, sorry about that, cash CHF. So how much cash are we getting? Well, we're getting the original rate. So that's going to be 400,000 times the original rate was 1.2. So October 1st, year 6. Times 1.2. And we calculated it earlier, so you could have just pulled that number from there. So that is the original rate. Now, the cash that's going in foreign currency is going to be the spot rate or the forward rate on the date of the end, the settlement. Why can it be both? Because they're the same. So 400,000 times 1.19, and technically that's the forward contract rate, but it's equal to spot on that day. That works out to 476. Are we done? No, we're missing 4,000 and it's a credit. Well, isn't it convenient that we have to close out the forward contract? So that's our 4,000 and that's our credit to forward contract. And that's totally from up there. Now, the final step for the purple guy, the forward contract, is we have to reclassify the OCI gains and losses. So classify OCI gains and losses to net income. So we need to see the balance in OCI gains and losses. And if you had two separate accounts, you just net them out. So originally we had a loss of 8,000, and that's from your entry on your last page. And then we had a gain of 12,000. So we're sitting here with an overall gain of 4,000. So we've got to close that off. We're going to debit OCI gains and losses for 4,000. And because this was a sale, we put it to sales. Okay. cash flow hedge. And it was for an unrecognized firm commitment. So now let's go on and do the fair value hedge, which is part C. What are the chances? And this is a fair value hedge. We're going to recognize in profit gains and losses from hedged item in advance against gains and losses from the hedge. Weird, we're recognizing something in advance. So October 1st, year 6, no entry for sales contract and for the forward contract, just like on the last page. Trend. So December 31st, year 6. And the first thing we're going to do is write the forward contract in color. So no entry for the hedged item, which is the sales. But we do need to write contract to fair value. So remember, we're giving CHF looking here, CHF has gone up, so it costs us more to buy a wheelbarrow full of CHF, and so it's going to be a loss. So that's no different. CHF went up, so it's a loss. So we're going to debit loss on exchange, 1,000, and credit forward contract for 8,000. And that was just the 400,000 times 1.22 minus 1.2. So same here. Different is that we now have an entry for a gain and loss on the hedged item. Okay, so there's no sales entry, but there is a gain or loss on the hedged item. So record opposite matching gain and loss on hedged item. So they had a loss here. So we're assuming it's perfectly hedged, and we're going to record a gain. So we're going to credit gain on exchange for 8,000. So notice it's the opposite, but it's the same dollar value. Now we have to put it somewhere, so we're going to put it to, it's either going to be an asset or a liability. Are there 2 T's in commitment? Yes, let's pretend there are. Commitment, asset, or liability for 8,000. If you did the balance now, it would be an asset because it's a debit. So we're good. Now we get to settlement date. So January 31st, here's 7. Settlement. So first thing you're going to do is mark the forward contract to fair value. And just looking at our little chart, our forward contract, DHF went down. We're giving, so that's good for us. We're going to have a gain. Nothing different here, you guys. Same as with the last one. So we credit gain on exchange, except we don't put it in OCI. And it was 12,000, which was 400,000 times 1.22 minus 1.19. And we debit the forward contract. Now, just like here, remember this is a fair value hedge, we're going to match the entry. So second, match with opposite gain or loss on hedged item. So we have a gain, so this time it's a loss on exchange, 12,000. Credit the commitment set liability for 12,000. And again, we're just matching the same amount, but opposite gain or loss. So let's just see what the commitment asset or liability has. It has 8,000 in it from up here, there. So 8,000, and then 12,000. So if you did a balance sheet right now, it would be under the liabilities section. Now we're going to settle. Actually, let's record the sale. So record the sale. Again, you guys, the order of these don't matter as long as you do this fair value first so that you can match this. Obviously, you can't do this one before that one. Okay, we're for the sale. Spot rate. So debit cash, credit sales for 400,000 times 1.19, which is 476. Okay, so now we're going to continue and we're going to settle the forward contract. Forward contract. Well, our first entry on January 31st, put 12,000 here. And then our last entry, our December 31st entry. We have a credit of 8,000, then a debit of 12,000. So I've got my 8,000 in here. I forgot December 31st. So we've got 4,000 sitting here as a forward contract, and it is an asset. So we know we have to close this. So we're getting cash. And from our little diagram here, this diagram and understanding is critical. We're giving francs, getting Canadian. So we're going to debit cash Canadian and credit cash CHF. So how much cash do we get? The original rate, which was 480. So that's 400,000 times 1.2, which is our original rate. The cash we're giving is going to be 400,000 times the forward contract rate at the date, which is, looking at our little chart, 1.19. Forward rate on settlement. What if they don't give you the forward rate? What can you use? You can use the spot rate if you need to. So 2,476. The other one, we have to close this off so it happily balances. Forward contract, 4,000. And we're good there. Now, the very last thing we have to do is still with the commitment asset liability. It's still sitting with the balance, a liability of 4,000. So we can close it now. So step 5 is going to be close the commitment asset liability to sales. And remember, if it's a purchase, then you're closing it to purchases or cost of goods sold or inventory or whatever you're working with. So go ahead and try a question like that. Okay, so know from this last page where we drew a little picture, we've got a liability and we have to close it. So to close a liability, we're going to debit commitment asset liability for 4,000, and that's to close. And this time it was a sale, so you're going to credit sales. Okay, so that's the parts I wanted to do for problem 10.6. The reason I wanted to do it is I didn't like how the solution, when they put them side by side, it's so confusing. So I wanted to talk you through everything. The key thing, you guys, for these questions is these diagrams and knowing which direction it's going, okay? Sometimes they're not clear. Here they say forward contract to deliver. They might just say forward contract and leave this out because they know it's going to be the opposite of what's happening here. So don't panic if you don't have, you're going, well, which way, who's getting it, which, just draw your first diagram. Your second's going to be opposite. So I'm going to stop this one here, and I'll do a separate recording for the other two so that you can pick which one you want to look at. In the next video.